Hello, hi, welcome back. Let us continue this lecture. I have two questions that I would like to try. Yeah. Um, Welcome to every one of you. I want to try to these two questions is testing or explaining the concept of fair value of liabilities. For value of asset is more straightforward. I think you will not have any problem to understand how to determine what is the measurements for assets, for example, for PPE, property, plant and equipments, for biological assets. Okay, but for liability is a bit different. Yeah, so I would like to try these questions. Okay, from this question, you're going to learn the concept of fair value of liability. Okay, so I want to explain about decommissioning liabilities. What is decommissioning liabilities? Mean any cost, any charges, expense, liability, and obligation incurred in abandoning or decommissioning any asset, property, but not limited, including but not limited to well and facility, whether such loss, charges, expense, liability, and obligation are incurred pursuant to any statutory, common law, or other obligations, any and regardless of negligence on the part of the seller. What it means? To give you a simple example, we in UAE there are many oil platform. Oil platform, yeah, they have this oil rig or oil platform situated, yeah, maybe offshore or onshore. Offshore, I think offshore, yeah, offshore. So they built these platforms. They get the government contract. Maybe the company got government contract from the governments, okay, to explore oils, to extract oil from the sea, from the grounds, yeah, and then maybe the well there, call it the well, based on the engineers or geologists' expectation, the oil reserve can last for maybe 15 years. Put it as 15 years. Any year, just pick any numbers there, 15 years. So after 15 years, there's no more oil. Or there is oil, but the cost of extracting or cost of extracting the oil will be much higher, will be not feasible anymore. So, after 15 years, the company has to stop their operations. Okay. So, in that agreements with the governments of the big company, your company has not only when after 15 years abandon that place, but you must remove the platform. You must cover the seal, the oil, the well. You must seal the well. You must remove the platforms. All right. Decommissionings. Okay. Okay. That platform. So it can incur many costs, labor costs, overhead, legal costs, and all these costs will only incur, okay, at the end of that process, at the end of the extraction or extraction period. So that is what we call as decommissioning liability. Can you follow me? Yeah, decommissioning liability. You cannot simply abandon that place. You have to clear up everything and remove your asset from that place. Yeah. So this is example. This is all platform, all rigs. Yeah, this is not necessarily in UAE. Maybe I just took this photo from the Google from Google. So after certain number of years, you have to remove these assets. You have to clear this equipment. Okay, so you have to dismantle. Yeah, so it's going to incur. You're going to incur millions of dollars to remove this equipment. Yeah. So on 1st July 2022, okay, Panda Limited assume a decommissioning liability in the business combination. Mean Panda acquired another company, and that company, the new subsidiary, has a decommissioning liability. So the entity is legally required to dismantle. Mean under the contract, under the law, the company has to dismantle, has to remove an offshore oil platform, this platform, this platform, shown platform, okay, at the end of its useful life, when the extraction of oil ended, that is to be in 10 years. So in 2032, you have to incur a big amount of expense for dismantling and removing this offshore oil platform. If Panda Limited were contractually allowed to transfer its decommissioning liability to market participants, maybe you can sell the liability, transfer the liability to company B, you have to pay them, yeah. So Panda Limited consider that market decision would need to take account into the following important. For example, this is our liability. We don't want to have this headache later on, so we sign the contract with another party. For example, company C. So you are required to dismantling to do all this job, dismantling this oil offshore oil platform. This is what I call as a chance to transfer the liability to market or other market participants. So in that case, you need to determine what is the fair value of that liability. So some of the information given here is the cost incurred. Yeah, you expect the labor cost will be 152,500. That is the labor cost. The fixed overhead is $115,000. Okay, and the contractor, certainly they will charge you certain margin. They also want to make profit. They don't work for free. So the contractor will make a profit of 20% of the labor and the overhead cost. So 152 plus 115, and then on top of that, you need to pay 20%. Maybe they will mark up you 20%. So that's the cost incurred. Okay. And whatever cost you estimate today will increase over time. Whatever cost you estimate today will increase over time. This is what I call as inflation cost. Yeah? Inflation factor. Every year, the cost will increase. The cost will increase. Okay, by 4%. By 4%. So you need to multiply it by 10 years. You need to do some calculation. There's future value calculation. How much is going to cost you in 10 years time? So every year it's going to increase by 4%, and then another 4%, another 4%. Okay, so that is what we call as the inflation cost. Okay, market risk premium paid for undertaking the risk. This you have to pay for the risk. Market premium paid is 5%. Okay. The time value of money representing by the risk-free rate of 5%. This is how you're going to discount the project later on. Okay. And then the non-performance risk, including its Panda own credit limited, is another 3.5%. So this is the risk-free, and this is your own risk. So the total discount rate you're going to use is 8.5%. Can any one of you take maybe 3 minutes or 4 minutes to go to this question and don't go to the answer? Yeah, try to understand what it means. Can you just take out your calculator and try to see how much you need to pay or to complete these activities of dismantling and removing offshore oil platform in 10 years. Yeah, at the end of the 10 years. Can you do that for me? How much is going to cost you? Can you take a calculator and try to see at year 10? I'm not talking about year 1 now. I'm talking about year 10. What will be the value here that you need to pay? Can anyone help me with that? Okay, please take your time. Okay, welcome back. Okay. Okay, so this question is about decommissioning liability, where at the end of year 10, you are going to dismantle. You're going to remove the offshore oil platform, And the expected cost today for labor is 152,500, for overhead is 115,000, and the margin charged by the contractor is 20%. So first thing you need to do is you need to calculate what will be the cost today, and from there you're going to work out on how to determine the future value, future cost at the end of year 10. So I'm going to, okay. So you are required to determine the fair value of decommissioning liability at 1st July 2022 using the present value techniques. So the answer will be, first, you calculate the expected labor cost. This is your expected labor cost, 152,500. Yeah, this one is at 1st July 2022. At 1st July 2022, okay, this is the amount you're going to pay for the labor. Then you plus at the allocation of the allocated overhead cost. There is 115,000. Okay, 115,000. And as I mentioned before, the contractor profit margin will be 20%. You total these two figures and then you multiply by 20%. Okay, total these two figures and multiply by 20%, because the question state that the profit margin is 20% from the labor and overhead costs. Be careful on the question. For your quiz, for example, if I put the gross profit, so the contractors, the margin, the profit margin just will be 20% of the labor cost, so you don't have to add up the overhead costs. So be careful when read the questions. Yeah. Okay. So how much is going to be? 0.2 multiplies by 152,500 plus 11500. So you total up this labor, this is labor, and this is your overhead. Overhead, total these figures, and then multiply by 0.2. So that will be the gross profit margin. The contractor's margin, 53,500. So your total cost, cash flow before inflation adjustment is 321,000. What does it mean? This is the price today. The cost today. Year zero. Year is equal to 0. Year 0. Yeah. T is equal to 0. Okay. However, if you do it next year, the cost 321,000 will increase by another 4%. Okay. Next year. Another year, it will increase by another 4%. Keep increasing by another 4%. That is what we call as inflation cost. So how are you going to determine the inflation cost, the total inflation cost? So you need to do this formula. There is 1.04 power of 10. 1.04 power of 10. Yeah, it increased 4%, 4%. So the best way is use this formula, 1.04 or 1 plus the inflation power of 4, or power of n. N is 10. So you'll get that figure. And then this figure you multiply with 321,000. Multiply by 321,000. So you get 1.48. It means that after 10 years, the cost increased by 48%. Increased by 48%. Increased 4 years, 4% a year. After 10 years, it increased by 48%. So the expected cash flow adjusted for inflation will be 475,144. If you do the process today, it only costs you 321,000. It only costs you 321,000. But you cannot do it now because you still have some oil to extract. You have some mineral to take out. Yeah. So just leave it there. Okay, you continue your main activity extracting oil and gas. At the end of the period, you are going to pay 475,144,000. Okay, and then we adjust for the risk. They say the risk is 5%. Okay, so what will be the plus minus there? So it's going to be plus minus 5%. So just put 5% there. 5% multiplied by 475,144. That give you 23,000. That give you 23,757. So the expected cash flow adjusted for market risk will be 498,901. This is the value or the cost you expect at the end of year 10. This will be year 10. Year 10. If I draw the timeline here, this is your year 10. The cost will be 498, almost 500,000, 901. So this is the cost at the end of year 10. You need to determine what is the current or the present value of this 498, 498,901. So you have to use your discount rate. So the discount rate here is 8.5%. The risk-free rate plus your company's risk rate. So total is 8.5%. For 10 years is going to be 0.44. So you multiply by 0.4423. 0.4423. So you get this figure. This is your present value of decommissioning liability. So that figure will be, how to get this figure, 10.1, 10.5, you cannot use, 8.5, you cannot use the Pvif table. This is the Pvif table normally given to student during exam. But since that is 10.5, you cannot use this table because we have 10 here in between. 10 for 10 years, it should be between 0.386 and 0.352. So the formula for PVIF and PVIFA is given below. I think you did this during your Math 060 or your Math 100, I'm not sure. So PVIF equal to 1 plus R, the 0.085, okay, and then power of n, 10. So in that case, 1 divided by 1 plus 0.085 power of n. Are you okay with this? How to get the present value? How to get the present value? Or another, if you use computer, you just go to the Googles. Let me share with you. Go to the Google and just use Pvif calculator. Pvif calculator. Let me share my screen. Okay, let me share my calculator. This is your Google. You can use here Pvif calculator. There are many variables. There are many option variables. Just choose one. And then you put your rate there. This is your rate. You want to determine the 8.5 and the period is for 5 years. And then you calculate. And the system will give you the answer automatically. That is 0.6650. No, not 5 years, sorry. 10 years. 10 years. 10 years. So it's going to be 0.4423, yeah, 0.4423. Oh, I made mistake. It's not between 10 point. It's not 10.5. 8.5 should be here between these two. Okay, between these two. Oh, sorry, I'm not sharing here my table. Okay, so I did shoot wrong place there. It should be between 8 and 9 for 10 years. So the answer should be between 0.463 and 0.422. Based on your calculation, you know that you get 0.4423. 0.4423. That is the discounting rate, discounting figure. So you multiply this 498, multiply this 498 with 0.4423, that give you this value, 220664. I repeat again, This is your future expected cash flow after adjusting market risk. And then you multiply with your discount rate 0.4423. That gives you 220664. 220664. So this is your future value. Not future value, sorry, fair value. Fair value. Fair value of your liability. Fair value of your liability. Decommissioning liability. Are you okay with this? So the fair value of the to be reported in the Panda financial statement as at 30th June 2020, 20 or 2022? 2022, this is 220664. If you are required to show the extract financial statement, it's very easy. The question asks you to do that. Put the name Panda Limited, statement of financial position as at 30th June 2022, just underline there. And then you put liability. Okay. Then write down decommissioning liability. The amount is 220664. I might ask, prepare the excerpt mean the not complete, only that part. So you put the title, then you can just put blank here, assets. And then we have liability there, decommissioning liability 220664. This is how you're going to present your figure in your balance sheet. It's under assets, under liability. Category under liability. Any questions? Any questions? So that is for question number 1. Question number 1. Is it good? Are you able to comprehend? Are you able to digest this? Yeah. Okay, welcome back. Let us move to the second question, second example. Yeah, this is about debt obligation. On 1st January 2022, Cola Limited issued at par in a private placement 2 million. This is a liability. 2 million BBB rated 5-year fixed rate securities, debt securities with 10% interest coupon rate. If you're doing finance, you did for your finance paper before this, you know that the coupon rate is the interest rate is 10% annually. So you have a responsibility, obligation to pay the debt holder, the bond holder, 10% or 200,000, 10% from the 2 million bond every year. At 31st December, after 1 year, okay, Cola Limited still carried BBB rating. The rating is still the same. We have this AAA rating, AAA, all right? So this is the rating of the bond. I'm not in from that side, but that's how it works over there. Yeah, they have this rating. AAA, AAA is much better than BBB. Okay. Market condition, including interest rate and credit spread for BBB quality rating and liquidity, remain unchanged from the date of issue. Yeah, the rating is still the same. However, Cola Limited credit spread had deteriorated by 50 basis points because of a change in the risk of non-performance. So there is a drop in the credit spread. Okay. So if the debt security were issued at 31st December 2020, they would be priced at interest rate of 10.5%. So if you issue the debt on 31st December 2022, the debt interest or coupon will not be 10%. Because of this poor performance, you have to pay more debt. The risk has increased by 0.5%. So if you issue the debt now, the coupon rate will be 10.5%. That is to compensate the risk of the bondholder or the bondholder. So now you are required to determine the fair value of debt security at 31st December 2022 using the present value technique. So you need to calculate what is the present value of this debt. So this is 10 years, 5 years, sorry. Year 1, year 2, year 3, year 4, year 5. Okay. I want you to calculate the value of this bond. You did this in your finance, how to discount all the the coupon, and also finally you're going to calculate the present value for the bond, BBBB bond. This is the 200,000. This one also will be transferred there. Can you take 5 minutes? Try to solve this question whether you're able to determine the present value of this bond. Present value of this bond. 5 minutes, yeah? Okay, let us continue. Okay, I'm going to first calculate the coupon first. Okay, this is the bond. How much interest you're going to pay every year? How much interest you're going to pay every year? Your interest will be your interest, or they call it coupon, 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 is equal to 10% multiplied by 2 million. So your obligation every year you need to pay 200,000. This is your annual. So every year you have to pay 200,000, 200,000, 200,000 until the end of the 10 year, 200,000. So if you want to determine the present value for this, you have to use a discount rate. You have to use PVIFA. 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 I did show you the formula. This is the formula for PVIFA, how to calculate this PVIFA. But during your midterm or during your quiz, I'll give you the PVIF table. I'll give you easy figure, not 10.5. 10.5 is quite difficult for you to use your calculator. You need scientific calculator for that. Okay, so how are we going to do that? Yes. First, you need to calculate the fair value of debt security should reflect the price that will be paid by the caller limited to transfer the liability to market participant at the 1st December 2022 under the current market condition. So due to the change in the credit risk, the appropriate measure for fair value is the present value techniques. Because there are change in risk, you cannot use the 2 million value. 2 million value is correct. 2 million bond value is correct at 1st January 2022. But there are some market condition, changes in market condition. So we need to revalue the amount. So caller limited would assume that the market participant would use the following input. The annual interest rate is 10% multiplied by 2 million. That costs you 200,000 annually. So the principal amount is 200,000, 2 million. So the term is 5 years. When I taught finance back in Malaysia, we always draw this T diagram. I'm not sure how your professor do it with you, but I love to draw this diagram. So every year you're going to pay 200,000, 200,000 minus 200,000 minus 200,000 minus 200,000. And at the end of the 5th year, you're going to pay the principal or the face value of the bond, as you're going to pay minus 2 million. So this is the same figure here, the same figures. So you can use PVIF multiply by PVIFA 10.5. Why 10.5? 10.5 is the current risk factor, 10.5 for 5 years. And then this minus 2 million, you don't put the minus because you already know this is all figure. Automatically, this is liability. So you don't have to put the minus. You knew already this is the figure. If you do cash flow, and you need to put a minus. This one you multiply by PVIF 10%, 10.5% for 5 years. Okay, if you use your calculator, or you will get the answer here. For the first one, is going to be multiplied by 3.7429. This is PVIFA 10.5% for 5 years. Yeah. Second one, 0.6070. So this is your PVIF, F with the annuity, 10.5% for 5 years. So you multiply these two figures, you'll get the present value, and this is your total present value of your liability. That is 1962580, which is different from the original is 2 million. So as at 31st December 2022, in your financial statement, you must put the liability BBB, yeah, a bond or liabilities that the amount, the value is not 2 million, but 1962580. So this will go to your financial statement or balance sheet. Balance sheets. Are you okay with this? Are you okay? Because there is a change in the economic situations. So the value of liability is only 1962580. Okay, any questions? No?